Pull up any financing agreement you signed for furniture, a mattress, electronics, or a dental or medical procedure. Look for the phrase "no interest if paid in full within 12 months." That phrase has a name. It is called deferred interest. Roughly half of store and medical financing promotions are built on it, and most buyers never read past the word "free." Here is how it works. Interest is accruing from the day you sign. It is just being held back, hidden in the background. If you pay the full balance one day late, or leave even $5 on it past the deadline, every cent of that withheld interest is added back at once, retroactive to day one. Mild, you pay a few $100s you thought you avoided. Moderate, a $2,000 purchase carries a year of compounded interest dropped on you in a single statement. Severe, the balance you could have cleared now revolves at a card rate near 30%. People blame themselves for forgetting the date. The real cause is a structure engineered so that forgetting is the most profitable outcome. Then it cascades. The retroactive lump raises your utilization, your score dips, and your next loan costs more. It stays invisible because the offer is described by what you might avoid, never by what is silently accruing. The fix is simple. Pay it off a full month early and treat the stated deadline as already passed. Almost no one does, because the whole design depends on you trusting the word "free." Open your bank app and find whether you opted in to debit card overdraft coverage. Most people do not remember choosing it. The mechanism is called overdraft opt-in, paired with high to low transaction reordering. Studies estimate a small slice of account holders generate the large majority of overdraft revenue, and they are rarely the wealthy ones. Here is the part most people miss. When several charges hit the same day, some banks post the largest one first, draining your balance faster so that more of the smaller charges bounce, and each bounce is its own fee. A $4 coffee can trigger a $35 charge. Mild, one fee on a tight week. Moderate, a cascade of 3 or 4 fees from a single low balance morning. Severe, your account spirals negative, the bank closes it, and you land in a database that makes opening a new account difficult. People blame their own math. The real driver is the order the bank chose to process your payments. Downstream, a closed account cuts you off from direct deposit and pushes you toward check cashers that charge more. It stays invisible because the reordering happens inside systems you never see. The fix is to opt out of overdraft coverage entirely, so the card simply declines. Almost no one knows that option exists, which is exactly why it keeps earning. Look at your credit card statement and find the box that estimates how long it takes to clear the balance making only the minimum payment. The number printed there is often measured in decades. This is the minimum payment trap, and it runs on compound interest. Roughly half of active card balances revolve month to month, rather than getting paid in full. The mechanism is quiet. The minimum is calculated to cover interest, plus a sliver of principal, so the balance barely moves while interest compounds on what remains. Mild, a $100-200 balance costs you a few hundred extra over a year. Moderate, that same balance takes more than 10 years to clear and more than doubles in total cost. Severe, you are servicing debt that never shrinks while new spending stacks on top. People blame their income for being too low. The structural cause is that the minimum is designed to keep you paying, not to get you free. It cascades into chronic high utilization, a suppressed score, and higher rates on everything else you borrow. It stays invisible because paying the minimum feels responsible. You met the obligation. The fix is to pay more than the minimum, even slightly, every month. The lender prints exactly how long the minimum will take, and almost no one reads the box. Count how many buy now pay later plans you have open right now across different apps. Most users underestimate by half. The product is point-of-sale installment lending, and it has spread to a large share of online shoppers in just a few years. The mechanism splits a purchase into 4 payments and frames it as not really borrowing. Because each app tracks separately, you lose the running total. Mild, you overspend because the price feels smaller. Moderate, a missed installment triggers late fees, and the charge flips to a real interest-bearing loan. Severe, payments from several apps land in the same week and overdraw the account, stacking bank fees on top of lender fees. People blame their own impulse control. The structural cause is a design that hides the total and decouples the pain of paying from the pleasure of buying. Downstream, some plans now report to credit bureaus, so a forgotten installment dents your score. It stays invisible because 4 payments does not feel like debt. The fix is to track every open plan in one place and treat the full price as already spent. The convenience exists precisely, so you will not. Check whether your current car loan is for more than the car is worth. If you rolled a previous balance into it, it probably is. This is negative equity rollover. A significant share of trade-ins now carry negative equity into the next loan. The mechanism is straightforward. You still owe more than the old car is worth, so the dealer folds that gap into the new loan and stretches the term to keep the monthly payment looking flat. Mild, you pay interest on a car you no longer own. Moderate, you are underwater for years, unable to sell without writing a check. Severe, the car is totaled or breaks down, while you still owe thousands more than any payout covers. People blame the car for losing value. The real cause is a loan structured to hide the gap inside a longer term. It cascades when life forces another trade, and the negative equity compounds into the loan after that. It stays invisible because the monthly number stayed comfortable. The fix is to know your loan to value before you ever step on a lot. The flat payment is the bait. Find the last extended warranty or service contract you bought on a phone, an appliance, or a car. Check what it actually covers versus what fails. This is the extended service contract, and the markup on it is one of the highest in retail. The mechanism is simple insurance math working against you. The price is set so the seller keeps far more than they ever pay out, and the fine print excludes the failures most likely to happen. Mild, you pay for coverage you never use. Moderate, the one time you claim, the failure falls under an exclusion. Severe, you stack these contracts across many products and quietly spend more on coverage than repairs would ever cost. People blame bad luck when a claim is denied. The structural cause is a product priced to be sold, not to pay. Downstream, the commission incentive means staff push it hard at checkout when you are tired and deciding fast. It stays invisible because peace of mind is hard to price. The fix is to self-insure by setting the same money aside. The contract profits from the gap between what you fear and what actually breaks. If you own a life insurance policy that also builds cash value, find the page that shows fees and surrender charges in the early years. This is cash value life insurance sold as an investment, whole or universal. A meaningful share of these policies are surrendered within the first several years, often at a loss. The mechanism blends insurance and savings, then layers in commissions and fees that consume most of your early contributions. Mild, your returns badly trail a simple index fund. Moderate, you need the money and the surrender charge takes a chunk to exit. Severe, you stop paying, the policy lapses, and years of premiums vanish with little to show. People blame the market. The real cause is a fee structure front-loaded to pay the sale. It cascades because the high premium crowds out contributions to lower-cost retirement accounts. It stays invisible because it is sold as protection and growth at once. So questioning it feels like questioning your own family's safety. The fix for most situations is term insurance, plus separate investing. The bundling exists because complexity is profitable. If you bought an annuity, find the surrender period and the schedule of charges for pulling money out early. This is the deferred annuity surrender charge. These charges commonly run for 6 to 10 years and start high. The mechanism locks your money in place. Take it out before the period ends, and a declining penalty claws back a percentage of your own funds. Mild, you lose flexibility you did not realize you gave up. Moderate, an emergency forces a withdrawal, and the penalty plus fees erases years of growth. Severe, the product was unsuitable for your age or needs from the start, and exiting at any point means accepting a loss. People blame themselves for needing the cash. The structural cause is a contract built to keep your money parked long enough to justify the commission. Downstream, the illiquidity forces higher cost borrowing when life happens. It stays invisible because the pitch emphasizes guaranteed and safe, while the lock is buried in the schedule. The fix is to read the surrender table before signing, not after. The guarantee was always for the seller too. Open your retirement account and find the expense ratio on every fund you hold. It is a percentage, and it is charged whether the fund rises or falls. This is the fund expense ratio, the quiet tax on your own savings. The difference between a fund charging near zero and one charging 1% does not sound like much. Here is the detail that gives it away. Over a working lifetime, that gap can erase a large share of your final balance through compounding in reverse. Mild, you lose a little each year you barely notice. Moderate, your statement underperforms a comparable low-cost index for no added benefit. Severe, decades of high fees quietly cost you years of retirement income. People blame the market for weak returns. The real cause is a fee skimmed off the top before any return reaches you. It cascades because the fee compounds against you, exactly as growth compounds for you. It stays invisible because 1% reads as small, and the dollar amount never appears on a bill. The fix is to compare expense ratios and choose low-cost broad funds. The number was always printed, just never highlighted. If you have ever rolled over a short-term loan against your paycheck or your car title, count how many times. Each rollover is the point. These are payday and title loans built on the rollover. A large share of these loans are taken not to handle one emergency, but to pay off the previous loan. The mechanism charges a flat fee that translates into a triple-digit annual rate, then makes the full repayment due so fast that most borrowers cannot clear it and pay another fee to extend. Mild, one expensive, but contained loan. Moderate, a cycle where fees exceed the original amount borrowed. Severe, with a title loan, you miss a payment and lose the vehicle you need to get to work. People blame their own emergency. The structural cause is a product engineered, so the short term is impossible to meet, making the rollover the default. It cascades into deeper borrowing and lost transportation. It stays invisible because each single fee looks survivable in isolation. The fix is a credit union small dollar loan or a payment plan. The trap was the deadline, not the dollar. If you are leasing furniture, appliances, or electronics with a weekly or monthly payment toward eventual ownership, add up what you will pay in total. This is rent to own. The total cost commonly runs to several times the cash price of the same item. The mechanism advertises a small recurring payment and never foregrounds the sum. You are technically renting, so a single missed payment can mean the item is repossessed with nothing returned, no matter how much you have already paid. Mild, you overpay for convenience. Moderate, you finish paying and have spent double or triple retail. Severe, you miss a payment near the end and lose both the item and everything you put in. People blame the price of the goods. The real cause is a structure that hides the multiple behind a tiny installment. It cascades because the lost payments leave you with nothing and still needing the item. It stays invisible because no large number is ever shown. The fix is to compare the total to the store price and save instead. The weekly figure exists to keep the total off your mind. If you own a timeshare, find the clause covering annual maintenance fees and whether they can rise. Then try to find the exit clause. This is the perpetual timeshare contract. A large number of owners report they would not buy again and cannot easily get out. The mechanism sells you a recurring obligation framed as a vacation asset. The maintenance fees climb every year, often for life, and the contract can bind heirs. Mild, you pay rising fees for trips you rarely take. Moderate, the fees outpace simply booking hotels, and the unit has almost no resale value. Severe, you cannot sell or give it away, and exit companies charging steep fees may deliver nothing. People blame their own changing schedule. The structural cause is a contract designed to be permanent and to escalate. It cascades into so-called exit services that can be a second trap layered on the first. It stays invisible because it is sold during a vacation, when your guard is down and the room is comfortable. The fix is to refuse the same day signing and walk out. The pressure to decide now is the tell. Scroll through your card statements for recurring charges you forgot you authorized. Look for the ones that started as a free trial. This is the auto-renewing subscription, built on dark patterns. The average household underestimates its recurring spending by a wide margin. The mechanism enrolls you with a card on file, converts a free trial to paid silently, and makes canceling far harder than signing up. Mild, a few dollars a month you meant to cancel. Moderate, several forgotten services quietly draining a meaningful slice of your budget. Severe, a price hike or annual renewal posts before you notice, and refunds are refused. People blame their own forgetfulness. The real cause is a design built to make starting effortless and stopping difficult. It cascades because each small charge is too minor to fight, but they add up to real money. It stays invisible because the amounts are engineered to sit below the threshold where you bother to act. The fix is a periodic audit of every recurring line. The friction to cancel is not an accident. If someone you trust from your community, your gym, or your place of worship is offering you a chance to earn by recruiting others or buying inventory, ask one question: where does the money actually come from? This is multi-level marketing and its overlap with affinity fraud. Research consistently shows the large majority of participants earn little or lose money once costs are counted. The mechanism rewards recruiting over selling real product to outside customers, so income flows upward from new recruits rather than from genuine sales. The trust comes built in because the pitch arrives from someone you already believe. Mild, you lose a few $100s on starter inventory. Moderate, you spend heavily on stock you cannot sell and strain relationships pitching to friends. Severe, you sink savings into a structure where, by design, almost everyone below the top loses. People blame their own effort, told they simply did not work hard enough. The structural cause is a model where the math only works for the few at the top. It cascades into damaged friendships and shame that keeps people from speaking up. It stays invisible because the messenger is trusted, and the losses feel like personal failure. If you think you have been pulled into something built this way, your state's Consumer Protection Office or Attorney General is where it gets untangled. The fix is to ask where the money comes from and to leave if the answer is other people joining. The trust was always the mechanism, not the proof.